Oliver Bonallack.
The human species is teeming with talent. So why are so many excluded from shaping its trajectory? Well, in my view, the answer is simple: access to capital. I study social sciences, not finance. So naturally, I think a talk about venture capital needs to acknowledge that capitalism is not perfect. It has deeply enduring and embedded challenges. And I understand that many of you will be thinking there is absolutely no way that debt-based stakeholder capitalism can offer lasting solutions to many of the problems that it's facilitated. But it is here, and at least in my view, it doesn't look like it's going anywhere. The reason I lead with this is because I don't want, for a minute, for this talk to come across as blindly technologically optimistic. The idea that somehow just a little bit more money, more technology, more investment will get us out of all of the problems that we face. That is absolutely not the case. Transformative social and political solutions are required across the board. But so long as we live in a society with extreme private wealth, I do want to cast a focus on venture capital, specifically enhancing this sector, reiterating its disruptive potential for change, an arena that itself needs change. But what exactly is venture capital? It's the sector that we all indirectly trust to invest in new early-stage businesses and technology that change our society. And so change using venture capital is therefore highly pragmatic. It's a pragmatism that engages with the real power, including political power, wielded by the financial forces of the world. And in the same vein, it reconsiders entrepreneurs as societal changemakers. After all, they speak the language of money. And equally, it recognizes the widespread desire to create change whilst seeking financial compensation. After all, you don't have to be a genius to notice that financial compensation is evidently a huge consideration for many. You just have to look around. UK universities produce investment bankers, fossil fuel employees, hordes of consultants, and most tragically, weapons engineers. These aren't ideologically driven careers. We have to tap into this financial desire for good. Because there's huge multi-directional pressure on the individual, both to assess their own impact and to succeed. Consume right, have difficult conversations, vote right, protest right, but obviously don't protest too disruptively, and succeed, make us proud. So when I think about these things, I feel at a bit of a crossroads. I understand why some people are driven in certain directions. After all, many of us are studying, getting into loads of debt, some of us already working, and most of us thinking about ways to market ourselves to corporations for future careers. And so our paths are therefore somewhat predetermined. Most of us have to work. This quote springs to mind. It is difficult to get a man to understand something when his salary depends on his not understanding it. In short, money drives people and creates a cognitive dissonance, doing things we don't necessarily agree with, either knowingly or unknowingly. We therefore need to harmoniously channel more financial opportunities into our spheres of employment that align with positive impact as the norm and not the exception. We can and we should kick the harmful incumbent companies off campus, just like fossil-free careers and students advocating for arms off campus are trying to do. But so long as there are not enough opportunities off campus, people will still go looking. I was told a good TEDx talk is about taking an idea that's important to me and rebuilding it inside the minds of the listener. So can I get a show of hands? How many of you guys, when you think about finance and hear the word finance, imagine what's on screen right now? Yes, this dominates our image of stewarding money as a business model. There are entire degrees dedicated to just this type of finance. But the unfortunate reality is the financial establishment of shuffling money back and forth at really high speeds and ultimately producing nothing cannot instigate meaningful change. But finance also looks like this: financing the companies that change the world for the better, impactful venture capital. And to do it right and to do it best, it needs to be inclusive. You don't need to own a finance bro gilet. This is the Blue Earth Summit, Bristol's leading sustainability business conference. I bunked off uni and I winged my way in, and I met people building businesses that absolutely blew my mind. A company using precision fermentation to create nearly molecularly identical cheeses that don't require any animal exploitation. A company building durable vehicle tires that release far fewer microparticles, a leading form of air pollution. 2 companies making packaging, one from mycelium and one from seaweed, and a company capturing carbon dioxide from the atmosphere using enhanced rock weathering. I was mesmerized, but more importantly, I was refreshed because all around me were investors looking to invest in these good companies, and not just to feel warm inside, but as viable investment opportunities. So I started looking deeper. This is Sustainable Ventures, a venture firm in London, backing founders solving climate-related issues with capital and 12 months of support. They have a climate workspace for collaboration and connection, and that's a wall of some of their member companies on the left. What's a clear takeaway from both of these examples? Additionality, as a result of human connection. Now, additionality was originally popularized in the carbon credit space, and it meant a new removal of carbon dioxide from the atmosphere as a direct and provable result of your money. And so, in impact investing, additionality means money making distinctively new impact that would have never otherwise materialized. Not just investing in an impactful company who would have grown fine without your money, or an impactful company who wouldn't have cared if it was your money or somebody else's money, but rather additional value added, actual contribution. And so here, people coming together with complementary expertise, ideas, time, money, space, community, and motivation to solve these interdisciplinary challenges and create this brand new impact. The head of impact at the European Investment Fund has said that impact investing mostly fails. All it does is create this predictable and inevitable impact that's merely a byproduct of conventional financial returns. Impact that would have happened anyway. So he contends that genuine impact investing and an expectation of strong financial returns are completely incompatible. I have to disagree here. Impact investors fail when they lack this additionality we're looking for. And additionality is here representing the need to think like impact entrepreneurs. Getting stuck in, creating and seeking out the opportunities for impact that would have never otherwise materialized. Channeling their own expertise whilst being humble enough to recognize the gaps in their knowledge. Not being as soulless as the money they've been entrusted to steward, but rather invigorating startup ecosystems from the ground up. Challenging internal assumptions as to why that person could never have done that, or that would never work. VC has this incredibly unique ability of engaging the incredibly financially powerful, in this case limited partners, on agreeable terms, the language of money, obtaining liquidity without somehow ripping it from their clutches. And let's be clear, if VCs weren't offering to invest money on their behalf, they'd be more than happy to recycle their money in traditional equities and bonds, which have more capacity for harm and less capacity for impact. So it's the LP money that originates the flow of money down and hopefully back up this chain. And capitalist market mechanisms pride themselves on efficiency of allocation. But when analyzing this chain, something isn't quite working here. The average missions, identities, and concerns of venture capitalists do not align with those of wider society. And diversity VC data exposes these core failings. 71% of VC partners in the UK are privately educated, compared to just 7% nationally. The industry at the very forefront of redefining how we operate as a species, and yet only 30% are women, with many in non-investment decision-making positions. And 76% of the industry is white. So I guess it's a little bit ironic that I'm standing up here as a white, privately educated man mentioning these things. But the reason I am is because I understand what environments of elitism look like and feel like. But more importantly, how they act, especially when they truly don't care how devoid of diversity they are. People spend their formative years around others who look and sound exactly like they do, and that's how these situations manifest. It wasn't until an exposure to all of the new perspectives that came with transitioning to a state sixth form college that I truly internalized and began the process of recognizing that I was in a bubble. So this makeup acts as a warped filter between serious money and decision-making, an interface for change. And so the makeup we see in the selection process reminds us why, in VC, diversity needs to be seen as a resounding strength and not a chore. Otherwise, the makeup we see reflects which founders get picked, and ultimately, which problems get solved. For example, in 2022, just 1% of VC funding in the UK went to black founders. So, knowing this, we can choose to look beyond traditional performance indicators, working to build holistic skill and talent profiles that transcend conventional accolades. Things like distance traveled in life, challenges overcome. But to integrate this understanding into the industry, we need a new ethical generation of venture capitalists, because increasing not only the volume, but also the fairness of the financial throughput in this chain begins with recognizing that the entities above us and below us are just people, or organizations guided by people. And I believe in the power of human connection. So engage, speak profoundly from the heart. Recognize that every link in this chain is a link of mutual teaching and understanding. Very human wants, needs, and fears, conveying the problem you wish to solve, why it relates to the entity above you and the entity above them and wider society, and articulating the stakes at hand if that problem goes unsolved. Because if all we see is money and prospects of more money, then we forget to connect on a human level first, at the detriment of money. Because if you truly fail to understand why somebody wishes to solve an issue, you'll be doomed to underestimate their relentless ambition to solve that issue. And this is why the best, or I should say the most disruptive early stage VCs are incredibly strong listeners and communicators. Above all else, they build decisive conviction in people. And in building these positive relationships, more people are attracted to that positive brand they emit. Bootstrapping, angel investing, and crowdfunding are all really viable and often preferable options for building a company. But in my view, it's really crucial that we unlock this idle LP money, and there are a bunch of different ways that can be done. For example, solo VCs that learn and operate at the forefront of their industry, acting as super connectors, learning and building expertise and driving that sector forward. We also see venture studios that incubate ideas in-house, often physical premises, offering support, money, and capital over a longer period of time, similar to accelerators. We also see syndicates that pool capital and leverage the knowledge and experience of everyone present for deeper due diligence and better insight. But regardless of whichever model, VCs will usually be investing widely, expecting many failures and looking for the huge outsized returns that make it all worth it. And they'll be using imperfect information when they invest too. But regardless, they should be entering all of these multiple partnerships guiding equally, being present for their founders, vouching for them, appreciating the risks they're taking. For example, the VC I intern under has a 24/7 phone line for advice and support. And whether investing as a sector specialist or a sector generalist, beginning to consider implications of social sentiment and policy that are going to mandate and influence how our industries and economies must evolve. Now has never been a better time for venture capitalists of all theses to start thinking, how will my investment benefit humanity? And that's because the impact startup landscape is huge, too big to cover in detail because it includes both individualized and overlapping sectors, from mental health to female tech, to boosting accessibility of legal and financial services, to conscious consumer products. I firmly believe we're going to see even more incredibly large companies that reimagine all of these sectors and positively disrupt the status quo. And my personal environmental fascinations, from climate tech to ocean tech to clean tech, ranging from decarbonization to algae to transport. In 2023, both clean tech and energy both saw 12 $1 billion companies, each according to Crunchbase. Why is this? Well, in finance, risk has always preceded opportunity. And so equally, the very real risks, harms, and dangers we see all around us in the world do directly correlate with material financial opportunities, even the risks we can't even see coming yet. And that's not to say that every problem is best solved as a business, definitely not. But it is to say that the pervasiveness or magnitude of a particular problem that you want to solve can be reimagined as an addressable market. And that's if you want it to be, and someone is either willing or forced to pay for that. This should energize my generation to solve, mitigate, adapt, and create the jobs we want to see in the world, and be rewarded for it. Because just as vital political change is fueled by willpower, complementing that within the sluggish and often problematic private sector relies on unstoppable individuals and teams, with both the logical and emotional intelligence required to connect and unlock stagnant wealth and connect it to change makers. So I think being the change we want to see in the world is a little bit vague, cliche, and ambiguous. So rather, let's connect to fund and build the change we want to see in the world. Because the sad reality is nobody else is going to do it for us. So if you're torn between making money and making a difference, instead of getting a job at a conglomerate that just doesn't care, follow or guide the money into an impactful area that inspires you. I promise it will pay off. Thank you.